As a long-term investor, you should be happy that markets are falling.
Sure.
I think goal is that part of investing that most of us don't really understand, which is the most important part. And the day you realize you don't have monies, right, you will not be able to understand which amongst these goals are not a priority for you.
Yeah.
I'm not sure if a lot of people will appreciate the comment that I'm going to make now. A lot of families actually have a problem when their fathers retire. Like Shah Rukh Khan says that only give this philosophy once you made a lot of money. I'm of a very firm belief that in investment, discipline is the most important thing. One medical expense
It takes you down.
and you are bankrupt. SIP is actually only working when the markets are falling. They're like, why are you fooling with me? I told you I want to do aggressive investments and I need higher returns. And I'm just hoping that basis this conversation, whoever's listening us will take a cue. In fact, my thought is completely opposite of this.
Hi, welcome to another exciting episode from the House of Equentis, where we bring you insights into the world of wealth creation, long-term investing, and achieving your financial dreams. I'm your host, Jaspreet Arora, the Chief Investment Officer at Equentis, and today we have someone very special in the house. He's a serial entrepreneur, a visionary in financial education, and someone who truly understands the power of wealth management. Kirtan Shah. Welcome, Kirtan. Today, we are going to break down some myths and truths about wealth creation, goal-based investing, and how anyone can really work towards their financial goals. Yeah, hi. So let's start with something I'm sure everyone's curious about, goal-based investing. A lot of people throw this term around, but I think it's time we take a deeper dive. So Kirtan, when you talk about investing for a goal, what does that really mean?
Jaspreet, I think that's an interesting start to the conversation because I think this is the most important thing when it comes to investing. Goal, in my opinion, is a target, right? I'm sure a lot of us who go to the gym and work out, let's say you picked up a barbell to do biceps, right? Probably at the 6th repetition, you will probably feel that, you are tired and you will just keep it. But let's say if you have a goal that you want to do 12 repetitions, then the probability that you will do 10 is much higher. And that is what helps you.
All right.
And that what keeps you more disciplined and hence you can get a better output, right?
Sure.
I think goal is that part of investing that most of us don't really understand, which is the most important part. And goal, in my opinion, has multiple other subsections that a lot of us ignore. Like say, for example, let's say while you are identifying a goal for yourself, right? A lot of us don't prioritize or understand how important this goal is. Is this goal extremely important or this goal is not that important? Now, a lot of us don't even know why that's important. So I'll tell you, a lot of us might aspire to do a lot of things. I want to buy a Lamborghini, let's say, right? But in the scheme of things that I have and the kind of monies that I have, do I really have enough to buy that?
Yeah.
Right? And the day you realize you don't have monies, right, you will not be able to understand which amongst these goals are not a priority for you.
Yes.
So the first thing that you really want to do is prioritize your goal. The second thing that I see a lot of people miss out on is inflation, right? The third thing after you've understood inflation is where to invest. And the fourth thing, whether or not will you be able to invest enough for a particular goal. So let me give you an example to make this slightly more clear for the audience. Let's say I want to plan for my child's education. So I want to get my child to do some MBA, which is today costing 25 lakh rupees. But my child is going to require this education 25 years from today.
Right.
Or let's say 20 years from today. At 6% inflation, this 25 lakhs will become 80 lakhs after 20 years when the actual need arises. Now, there is no point for you to plan for 25 lakhs because 25 lakhs is not going to be enough.
Correct.
So if after 20 years, this 25 lakhs is going to be worth 80 lakhs, you might as well want to plan for 80 lakhs. Now 80 lakhs may come out to be a very large number,
Yeah.
right? But you do basic math and you will understand that you probably just need 8,700 rupees of SIP at 12% assumption for you to get 80 lakhs in 20 years from today, right? Now there are 2-3 things. First, I took inflation into consideration. I know my target is 80 lakhs. I know if I'm not disciplined, my child education is at stake, which will make sure that I'm disciplined.
Yeah.
And also 80 lakh as a number may come across very large, but when I say 8,700 of SIP, you understand that's achievable. I think that's the role goal plays, gets you disciplined and makes sure that you stay the course so that the target is achieved.
Beautifully explained. Yeah. So what I understood was what are the priorities? Is it important and urgent? If it ticks both the boxes, start planning today.
Absolutely.
And if it's important but not urgent, maybe you can always take it up. Take it up later. But beautifully explained. And I love the analogy that you took up of the gym thing. So the next is when people think of investing, they often feel like they have to make drastic sacrifices. Do you think it's possible to invest for an early retirement while still enjoying a good life? And what, according to you, is early retirement? Because that's, according to me, it's a very subjective term.
I think I keep saying this, and this is a very common question that is actually thrown at me because a lot of us keep talking about the FIRE number. And thanks to a lot of people on social media who made this popular.
Yeah.
For me, actually, the problem is not the number that you need to achieve. My problem actually is what are you going to do once you retire?
After you retire.
Between you and me, ask ourselves, if you and I have worked for 20 years, 12 hours a day, and suddenly somebody tells you you have enough money but don't come to work from tomorrow.
Yeah.
What are you going to do?
Exactly.
Right? Most people, and I tell you this with experience because we have such clientele that we manage who have the money, but they don't want to retire because they don't know what to do with it. So I think achieving that number is only one part of the story. You actually will need to build a hobby for yourself or to try and understand what are you going to do with the time. So I think that FIRE number, money is less important and what are you going to do with your time is more important.
Yeah.
But to answer your question whether this is achievable, I think I follow a very simple rule and I advise a lot of people who I speak with to follow this rule, and I've seen this rule work out, and the rule is 30-30-40.
Okay.
What's the 30-30-40 rule? So let's say if you have a lakh of rupee that you make a month, right? Make sure that 30,000 is the maximum amount of money that you take onto yourself for EMIs.
Okay.
Another 30,000 is the maximum you will spend for your leisure and your other expenses.
Okay. Consumption.
And the remaining 40,000 is what you invest. So 30,000 maximum EMIs, 30,000 expense, and 40,000 you invest. The 30-30-40 rule. If you do this, right, in probably 180 months, you will be in a situation where you are financially independent. Let me give you some numbers as to why am I making this comment. Let's say my salary actually is a lakh of rupees. 30,000 is my EMI, 30,000 is my expense, and I'm investing 40,000 rupees a month. If I invest 40,000 rupees a month at 12%, in 180 months, I'll be able to accumulate roughly 1.9 crore.
Wow.
Right? Let's say if 30,000 is my expense, which is 3,60,000 a year, at 6% inflation, this will roughly become 8.4, 8.6 lakhs a year in 180 months.
Okay.
Now, if I have 1.9 crore of corpus and I need to generate 8.4, 8.6 lakhs every year, all I need my corpus to generate is 4.5%.
Oh, less than FDs.
Right? Of course, you and I can argue that there is going to be inflation on that 8.4, 8.6 lakhs later on also.
Thereafter.
But the point is you are at least in a much comfortable situation that you will not have to bother about your living expenses anymore. So 30-30-40 rule will actually make sure that in 180 months you can be financially independent. So it is possible provided you follow this rule, which makes sure that you're not compromising on your lifestyle today, but at the same time you're moving towards financial independence in 180 months.
Beautiful. So what I can also understand from this is not necessarily you start this when you reach 1 lakh. So let's say anyone having 50,000 salary can do 15, 20,000.
Absolutely.
So it's you don't have to really wait for.
Absolutely.
And likewise, the formula continues. So let's say a person, Sahil, 35, 40 years, married man earning about 20 lakhs a year, wants to retire by 50, 55, let's say 20 years from now, without completely disrupting the current lifestyle. How will this be possible? What are some of the suggestions?
I think it's exactly on the same lines that I was just suggesting.
So 180 months, 15 years, here I'm saying 20 years. So you've actually front loaded it.
Correct, absolutely.
So you're saying, और जल्दी retire हो सकते हो.
All jaldi retire ho sakte ho.
If you are...
right? But the only problem here is that a lot of us will keep arguing as to why and how am I in a city like Mumbai going to be able to maneuver my cost between 30% as expense and 30% as EMI, right? So the argument definitely can be that, if I have to curtail myself in 30% of expenses, right, then I might not be able to live the lifestyle that I really want to live today.
Yes.
But ultimately, I think that at the end of the day, you will have to make some compromises for you to be able to take care of the other side and make sure that both are in tandem working for you and you are not compromising on one side of it.
Sure.
So I think if on both sides you compromise a little, you should be able to reach the goal far better, far easier than assuming that you will not be able to reach the goal because the expenses are very high.
Sure. So I guess let me just highlight what you also said, which is equally important, which is also figure out what will you do after 15 years or 20 years. पैसा बन गया बट उसके बाद कैसी जिंदगी गुजारनी वो भी थोड़ा सोच लें.
नहीं पता है लोगों को. नहीं पता. I'm sure people watching us, they have to ask themselves, do they know if they retire today, what are you going to do?
Exactly.
Because I have asked this question to myself multiple times that let's say if I have achieved my FIRE number, why do I need to work? And I was trying to argue with myself, okay, I will wake up in the morning, I'll go to the gym, then I'll go to the clubhouse, I'll go swimming in the evening.
How many days you do that?
How many days are you going to do that? And while you worked for these long number of hours for these many years, I can tell you it's impossible.
Yes.
I'm not sure if a lot of people will appreciate the comment that I'm going to make now. A lot of families actually have a problem when their fathers retire.
Yeah.
Because after 35 years of work life, when the father retires and he's at home,
then
it's a more difficult situation.
Because he's interfering and he's...
Yes, right? So it's not easy to retire with the monies that you have. Which is why I say in retirement, it's not really monies. Of course, like Shah Rukh Khan says that only give this philosophy once you've made a lot of money. But the point that I'm trying to make is that money is one part of it. Time is equally important, a criteria in retirement.
Great. So, I'm remembered of this quote by Warren Buffett, 2 rules that he speaks about. Rule number 1, don't lose money. And rule number 2, don't forget
the rule number 1.
So, in stock market, as we say, and, a lot of people advocate, there are no shortcuts. And so think before investing, research before investing. But it all boils down to risk management. So, how much importance one should, attach to risk management, and how are some of the things? What are some of the suggestions you would say people should can keep in mind to do that?
Jaspreet, I'm sure you will agree with me that all people in the money management business who've been veterans. They've all over a period of time said how risk management is far more important than any other thing in the world of investing.
Yes.
So when veterans with 30, 40, 50 years of experience tell you that, it definitely has a lot of meaning and weightage, which somebody who's just 3 years in investing will never understand or never appreciate. But if I have to still give you an analogy, let's go back to what happened in COVID.
Yes.
Right? In COVID was the first time people really understood the importance of contingency planning. Right? People lost their jobs, their salary became half because there was no work available. Is when people understood that had I had 6 months or 12 months of living expenses kept aside as emergency planning or contingency planning, I would have been in a better situation.
Right.
So what happened in COVID was because they didn't have contingency planning, right, or emergency planning in place, they actually had to break their investments to be able to survive till the time situation stabilized, right? Now, I'm of a very firm belief that in investment, discipline is the most important thing.
Correct.
So what I'm trying to allude the investors to understand is that because you didn't have risk management in place, COVID did not allow you to become a disciplined investor. You had to break your investments, right? That's the same case with any other risk management. And I keep saying this quite common because I know this is a common problem. Let's say mediclaim.
Yeah.
Everybody on the internet will come and tell you, you've got your first job, start doing an SIP. I'm like, don't make that mistake, right? You will do a 5,000 rupee SIP every month for, let's say, 5 years. You would have accumulated some 6, 7, 10 lakh rupees. One medical expense,
it takes you back.
and you are bankrupt.
Yeah.
So what's the whole point of doing the SIP for 5 years
Correct.
if that could not even help you take care of one medical bill, right? So, in my opinion, if you don't have the right risk management in place, it will not allow you to be a disciplined investor because you will go back wanting to remove money from your investments. And if you're not disciplined in investment, probably you're not going to be able to do anything great in investments.
Understood. So plan for contingencies first and maybe then start your investment plans.
Absolutely.
Great. So now let's get real. We're talking of long-term wealth creation here, but a lot of people are struggling with the current market, the way volatility is set in. So when market dips, or when you see a hot stock tips, and I'm again reminded of a quote by Peter Lynch who says that, far more people have lost money preparing or anticipating corrections than in the corrections themselves. So what advice, and again, there is this recent after Naren commented, SIPs and whether one should withdraw. So advice on SIPs as well as how to take advantage of market nervousness whenever it gives you an opportunity.
See, I think there is no better way to explain anybody this concept than helping them understand what happened historically, right? India in the last 2 decades have seen 3 major corrections. 2001 is when the markets corrected roughly 40%, right? Post the correction, the 5-year CAGR is close to 40%, right? The second biggest fall that India saw was 2008, 58 to 60%.
Yeah.
5-year CAGR after that fall is 18%. The third big correction that India saw was 2020,
COVID.
which is 38 to 40% fall.
Yeah.
5 साल नहीं हुआ है, but 3-year CAGR is 29%. Now the simple point here is, right, that while you and I keep talking about investing and expectation should not be more than 12%.
Yeah.
The fact of the matter is that the biggest falls in the history of Indian stock markets have given the biggest opportunities to make returns in the coming 3-5 years. I think that in itself is proof enough that if you exit, right, you are not going to be able to make this CAGR, which is the most appropriate thing to happen post such a great fall. Okay. And we've done this analysis on 13 such falls in India over the last 24-25 years. And every time something like this has happened. Okay. Right? To give you a context or an analogy on SIPs, right? I find it really funny when people say that I am stopping my SIP because markets are falling. Because it makes me believe that they don't understand what SIP is. Yes. SIP is actually only working when the markets are falling. Right. And not when the markets are going up. What's the concept of SIP? Concept of SIP is you put an X amount of money every month on a particular day without trying to time the market. Correct. Right? When the market goes down and you continue to do that, you accumulate more units. And at some point in time when the market goes higher, you will make higher returns. And I keep telling people that if you continue your SIP in a falling market, and if the market has made 12%, you will make 14% because you've accumulated more units. At the lower. But what are people more comfortable with? They're comfortable with markets going up. So they continue their SIPs when the markets are going up. In that situation, what happens is, even if the market makes 12, you make only 10. Now, what situation do you really want to be in? When the market makes 12 and you make 14? Or when the market is making 12 and you make 10? Of course, you want to make 14 when the market's making 12. Correct. But that's only possible when the markets are falling and you continue to invest. So it actually takes me by a surprise when a lot of people say that I'm going to stop my SIP because markets are going down, because you are actually taking away the most important reason of why you are doing SIP.
Exactly.
So my only one-liner now to anybody who's watching us, as an investor, as a long-term investor, you should be happy that markets are falling, because it's giving you an opportunity to accumulate more stocks or more units.
Exactly.
If you are getting scared that the markets are falling, either you are not a long-term investor or you don't understand investing.
Brilliant. So now there are two people from different generations. Let's say one is 30-year-old and one is a 60-year-old. How would you advocate within equity to split the corpus between, let's say, large cap, mid cap, and small cap? And assuming you want to split it, you want to have a differentiation between the two.
Yeah.
If you think there is merit in saying same, you can, yeah.
See, I think my very firm belief is personal finance. The reason why you call it personal finance, because it is personal to each individual. Yeah. I keep telling my father, who's now 67, that you've retired, you should start having more accumulation on the fixed income side. And he's the one who keeps telling me that you are in the wrong business. You don't understand the power of equity.
Wow.
So the point that I'm trying to really make is that it is very individualistic.
Sure.
Right? My father at 67 thinks that he wants to be in 100% equity. But I am very theoretically thinking that he's retired and he needs more money to be on the fixed income side. But of course, look, having said that, from a contextual standpoint, somebody who's 30 years old and has got 30 years more to do in investing will typically need to do a higher allocation or should do a higher allocation to equity versus somebody who's 60 years old who is now in the distribution phase and not the accumulation phase.
Yes.
So the 30-year-old is in the accumulation phase.
Yeah.
He wants to accumulate more and more units, more and more stocks right now.
Sure.
Because he or she has 30 years more to go.
Yeah.
And even if the market falls in the next 2, 3, 4 years, this individual's got another 25 years for the markets to recover. That may not be the privilege with somebody who's 60 years old, right? That guy may probably need to start receiving some cash flows out of the investments that he already has, because his active income may have stopped. So a 60-year-old probably, in my opinion, would want to focus slightly more on the fixed income side.
Okay.
Because his requirement is making sure that the capital is not eroding.
Yeah.
His cash flows are taken care of. And after having done this, if he can grow wealth, brilliant. But the 30-year-old guy wants to create wealth. And hence, the focus there is more on equity versus the 60-year-old guy.
Great. And how would you advocate splitting this corpus between the let's say large, mid, small cap?
So I have done some rolling returns and rolling risk analysis for the last 20, 25 years. And I've realized how a 33% in large cap, a 33% in mid cap, and a 33% in small cap as an allocation actually gives you large cap plus a little risk, but gives you mid cap kind of returns. Now, what do I mean? All of us in the world of investing want to be in a situation where we are able to take lower risk and generate higher returns. While it looks brilliant while we talk, but how do you end up doing it?
Yeah.
Right? And we've realized doing some data crunching at our end that the best way to do it is 33 large, 33 mid, 33 small. Now, a lot of people will feel that how with a 33 mid and 33 small, can you have a large cap kind of risk, right? You look at the last 10 years and you will understand that actually the standard deviation of large cap is 14 units and standard deviation of mid cap and small cap is 15 and a half unit. So that's not a lot of difference.
Much of a difference.
But the returns are significantly different. Like say, for example, in the last 10 years, large caps have done a 13% CAGR. Mid cap has done an 18% CAGR. So when you do a 33 large, 33 mid, 33 small, you are actually, what you are actually doing is large cap plus a little more than large cap kind of risk, and your returns are mid cap. That, in my opinion, is the perfect fit for somebody who's got 8-10 years of investment horizon and has the risk profile. right? And my personal investments are pegged the same way.
Oh, great. I'm reminded of those flavors which, some of these new age ice cream parlors are. So you have a guava chili and you have a coffee, some coffee flavor. So you get the kick and you also get the flavor that, so you have a slightly lower risk, and far higher reward.
I am hoping that it tends to continue, but historical data point definitely
10 years.
shows this is.
Anyone can take a 10-year view, and there's no reason why anyone should have a less than 10-year view, especially in a market like India, where we should be closer to 10 trillion, actually more than that. And I'm sure the Nifty CAGR of 13-14%, and as you said, mid and small cap could be far, far higher.
So
the real wealth is
when I was looking at the last 10 years data, and because this question get asked to me quite often, and so I keep preparing a little more on this every time. And I was looking at some last 10 years data, and I realized that while you invest in small caps, you expect small cap returns to be far higher than any other investments that you've done, right?
Yeah.
Because when investors approach us and they say that, I've got a 10-year horizon and I'm willing to take any kind of risk, but I want to generate higher returns. And we tell them that, okay, we will do 33 large, 33 mid, 33 small. They're like, why are you fooling with me? I told you I want to do aggressive investments and I need higher returns. Then why are you putting 33% of my money in large caps? So I was looking at last 10 years data, and I mean, I'm not surprised, but for people, surprisingly, small cap index has delivered only 16%, but mid cap has done 18%.
It's done actually, but better than
right. So it is not necessary that just because you've taken higher risk by investing in small caps,
market will reward you.
The market will reward you with higher returns, right? Yes. It's always a risk adjusted return, correct. Right? So that's what I would rather suggest that investors look at.
Sure. So, with so much of, content getting out from brands and regulators, why one must not enter the stock market, tips, unauthorized advice. So how do you think, we, as institutions and you as one of the advocates of, how can one promote a long-term investment, keeping the fundamental research as the background or the underlying pillar? How can you just... can you spend a few minutes there trying to highlight the importance of research and not just tips and social media?
Very honestly, in my opinion, you and I, with all our best efforts, will never be able to do this. I'll tell you why.
We'll make a small attempt.
I'll tell you why. I have been in the market since 2006. I've seen 3-4 cycles. Okay. One thing I've realized is that the new investor community comes to market only in a very large, big bull run.
Market, yeah.
Right? So when somebody comes to the market in the hindsight of a big bull run, right? The expectations are extremely high. Right? You and I would have gone through the same story in the last 3-4 years, where a 20-year-old guy would have come to us and told us, you don't know how to invest, I will teach you how to do it. Right? That's happened to all of us in this business, right? So the biggest problem is that the entrance is wrong. If somebody entered the market in 2018 and 19, their perception about market is very different, because after entering they immediately saw a fall. But if somebody comes to the market who's only seen a bull run and come to the market, they will never understand the importance of fundamental analysis, risk management, asset allocation. And the bigger problem is, the longer this bull market stays, the more they are invested. See, when they come in new, they don't go all out, right? They are coming in because somebody told them that, look, I made 20%, you are in FD at 7%. So they are like, oh, let me see what this is. So they'll start with 10,000. Now suddenly they see that the 10,000 is performing well. They'll put 1 lakh. Now suddenly in a year they realize, oh, I made 30%, right? And then you will see they go all in with 50 lakhs. Now, once they've got all in and the market ends up behaving the way it actually behaves, 9 out of those investors will never come back to markets. So the longer the bull market stays, more investors actually go out of the market, the newer ones, than the ones who actually stay back. So if you really ask me, I don't really think there is a way you will be able to teach them, except for them being able to learn from their own mistakes.
Sure.
The 1% or the 10% people who will survive this fall that you and I are experiencing right now are going to be good long-term investors.
Yeah.
The remaining 90 won't. And I'm just hoping that basis this conversation, whoever's listening us will take a cue.
No, great. I always have this advice that people who want to, people come to me and ask for investment sikha do. And then I'm like, it's like an analogy is like you're roaming around a swimming pool and you're saying कि मुझे swimming sikha do. First step तो swimming का है कि अंदर तो उतरो. Start walking, start taking baby steps. उसके बाद कोई swimming सिखाए. अंदर नहीं अभी कूदे नहीं और बाहर से swimming सिखा दो.
I think that's a very interesting analogy, of course.
So financial planning is a term that I have personally also somehow couldn't connect till a few years back, till the white hair started setting in and tab laga. But that's a area where you and your team are experts at. So but there's this thing with financial planning that people think it is only for people who have arrived in life and have created a bare minimum of wealth or have inherited a wealth. What are your thoughts around it?
In fact, my thought is completely opposite of this. I think financial planning is specifically for people who are absolutely young and absolutely new.
Okay.
I will tell you why. And I've said this on one of the other shows that I participated in, and I gave them my father's example, and I like to repeat that example here. So my father always thought that he's probably the best investment guy around.
Okay.
And he's done his investment planning in a way where everybody else is like, okay, trying to copy what he's done.
Oh.
Okay. And now I will tell you what he's done. So he's bought into 52 insurance policies from LIC.
52.
And this investment started some 25 years back.
Okay.
Now he did this investment in a way where 2-3 policies mature every year. So his plan was that while I am earning right now, let me invest in these policies. And when I retire every year, 2-3 of these policies will mature and my retirement will be taken care of. Now he was not wrong in his thought.
Yeah.
But it took him 20-25 years and
some bit of
my understanding now to explain to him that when these policies are maturing, he's not even made 6% on it.
But the implied IRR is very, very low.
Right? Is when now he realizes that he made a grave mistake. Right? Because he always looked at it as an investment and not as an insurance.
Yes.
Right? Yes. Not that he got any great insurance in that also.
Yeah.
Right? Now imagine if somebody loses 25-30 years of compounding, how much is that person going to lose out on?
Yeah.
We keep hearing on the internet how 1% makes a difference in crores over 30 years because of compounding, right?
Imagine 6 versus 10 or
imagine a 6 versus 12 or a 6 versus 10. How much would somebody lose out on? So I really think financial planning is actually meant to be taught to somebody in the college or even in the school.
Yeah,
right? And you actually need financial planning as an understanding when you get your first job, right? Because if you don't get your act together when you are extremely young, you're going to lose out on a huge opportunity cost.
Yeah.
Right? Somebody who's, of course, by that I don't mean that somebody who's 45-50 and made money does not need financial planning. But I think somebody who's 45-50 is made enough money, right? That they will have more capital to invest to take care of the lost ground.
Sure.
Which everybody may not have the privilege to do.
Correct.
So I think I'm of a very firm belief that financial planning is actually needed for somebody who thinks that I don't have the monies and not the other way around.
And about 20 years back, I was working with a firm called Angel, and I was first introduced, to this product called ULIP. And, I had this 2 hours of heated argument, and it was the top 3 private life insurers. And I simply understood they're mixing 2 products. And when I told her that if you break it up, you'll get far better returns. And she kind of, walked up in a furiated manner and walked out of the room. Like, you don't understand this product. And within 3 or 4 years, there was, hue and cry about how ULIPs are actually, and those times you were getting like 40% upfront commissions and, the good old days where it was like misused. And I've heard you talk about this very often, trying to. So just your thoughts on the beauty of term insurance, investments, and not to mix the two.
And I think I'm so glad that you asked me this question, and I'll tell you why. Let me ask you, in spite of so much of media effort of why you should not club insurance as investments, right? You still see the insurance sector growing at such a starking pace. And it baffles me a lot of time as to why. Who are these guys who are still buying those traditional products or the whole life insurance products or the endowment products, XYZ products as investments, in spite of so much of effort that everybody's made? And I've come to a realization that their marketing is very smart.
Yes.
Right? And I'll tell you why. Have you ever seen any insurance guy telling you what return will you make? The sales pitch is, invest 5,000 rupees a month and after 20 years, I will give you 2,10,000 rupees. So as a retail investor, you think 5,000 rupees a month, okay, 2 lakhs, okay, brilliant product, plus tax free, right? Or they will sell it to you saying that this will make sure that your child's education or your retirement is going to be taken care of. Nobody talks in terms of returns or XIRR, right? And that's the beauty of how this entire insurance industry works. Because the day you start telling your client the return you are going to make, right, they will understand that this is not the product that they really want to invest in. And retail does not know how to calculate the XIRR or the return. So what they've beautifully done is linked their product to a goal. Retirement plan, child education plan, so on and so forth, without discussing XIRR. So the focus is never on returns. The focus is always for you to be able to achieve the goal, which drives the investor community to invest there. Right? So I think it's beautiful of the way that they market. But of course, when you do the term insurance and the mutual fund separately, you are far better off, right?
Yeah.
Because let's say you do a lakh of rupee of premium in an insurance product today. You're getting 10 lakhs of cover, right? And you're not going to make more than 6% in any traditional plan. But you do the same stuff, right? And take term insurance plus invest the remaining amount of money in mutual fund, right? You will be able to accumulate far more wealth in mutual funds and you will probably get 10 times more cover than the cover that the policy is giving you. So you have a higher insurance also and you have a higher return also on your investment, right? Somebody will come back and say, but it does not help me save tax. Or somebody will come back and say that I don't want to take the equity risk. No problem. You do term insurance and you do PPF.
Yeah.
You will still get higher returns plus all the tax advantages that the insurance product brings on board. There is no reason, in my opinion, for you to stick to a traditional insurance product. There are far better combinations that you can do. It is just that the biggest advantage, in my opinion, that the insurance product brings on board is the forced lock-in.
Yes. 5-year lock-in? Yeah.
Because if you've invested in a 20-year product and you go to the insurer at the end of the 10th year and say, I want my money back, the insurer will say, I will pay you only 30% of the invested amount.
Yeah.
And then you suddenly start feeling, usse acha to chalne do yaar.
Yeah, that's again.
Right? That's the big problem in product like a mutual fund where you go and say you need the money, second day you have your money back.
Yes.
Actually, forced investment in insurance is a big plus. So if you're a disciplined investor, and you don't need this lock-in, you might as well do a term insurance plus a PPF or a term insurance plus a mutual fund because that is going to do far more advantage to you than a traditional product in insurance.
Great. So for all those people still educating Europe, Kirtan and me, we're not convinced today and neither will be tomorrow. But what I'm reminded of now is, I follow this guy, food farmer who's taught India and his famous slogan is label padhega India. So I think with whatever I heard from you now and even earlier, I think I can call you maybe wealth planning farmer and with this the audience will say XIRR puchega India, right?
I'm gonna use that and borrow that from you.
Yeah. Brilliant. Yeah. So let's take it slightly light now. What is one investing superpower that you wish you had and why?
I think it is discipline.
Great.
My mantra of investing is discipline. I really believe that a disciplined investor will eat the most sophisticated investor on the Wall Street for breakfast. You look at HFTs globally, you look at hedge funds globally, they spend crores on building tech and algos and all, still are not able to beat the index. Right? So if as a disciplined investor, you can stay invested for 20 years, I think you will be able to eat the most sophisticated investor in breakfast. So I think if I need a superpower, that superpower is discipline.
Brilliant. So, even our founder at Equentis Research Ranking, Manish Goel, he talks about the 3 C's, which is clarity, consistency, and compounding. I think all of that combine it, and with discipline, I think that's the true journey towards wealth creation. So,
Absolutely.
Great. So there's this thing now, with startups. That's the next big thing. Shark Tank has taken that to a different level.
Yeah.
And I saw the power of a concept like Shark Tank when about 2 years back, me, my son, my wife, and my mother-in-law, 3 generations were watching it together. That was the kind of power it had to, get the family together.
Yeah.
And it was just investments, but the way it was brought up, right? And so in this world of startups, what's your view there? How should one, at what stage of the career do you think people should get that into part of the portfolio? And how should one navigate that in terms of strategizing it? Like whose help directly go it through an AIF? We also have our own AIF Cat 1, right? We do startup investing, seek help or professionals like us. So what's your view on the startup world?
I think very largely because I speak to a lot of investors outside, I think investing in startup is more of a coffee table discussion.
Yes.
Right? You want to be able to talk to your peers saying that, I invested in that startup and then Deepika Padukone invested. Without even understanding what have you really invested in.
And just in case somebody asks for the returns, you may feel shy of saying one of them is bombed.
So I really believe that you should only do startup investing when you can cut 10 equivalent checks.
Okay.
Right? What do I mean? Let's say some startups approached you, you really like the idea and you're willing to cut a 50 lakh check. Now my question to you is, will you be able to cut 50 lakhs into another 9 such startups and do 10 startup investing? Only then invest in the first one. Because all of us in this business know the startup investing is a very different ballgame altogether.
Yes.
The gestation period is way too long and the hit ratio is way too less. 8 out of the 10 investments that you've made will not make the kind of returns that you really want. But the 1 or 2 that will make will cover up for all the remaining 8 that have not done well. Right? But if you are going to only invest in one startup, right, the probability of you losing money is far more than probability of you making money.
Yeah.
So if you are going to be in a position to invest in 10 startups, then only start this journey so that even if 8 don't work, the remaining 2 will really be able to do well. And I think because I started the conversation, I firmly believe that this is largely a coffee table discussion for Indian family offices today, right? Most of those guys don't understand why are they investing in the startup that they are looking at investing in. And hence a professional advice is definitely a must when you are trying to do startup investing. And I would like to believe that AIF is a brilliant way to invest in startup because it solves the problem that I'm raising. When you invest in a Cat 1 AIF, you are automatically investing in a basket and not one, right?
Yes.
So the probability of you being able to do well is far more superior than trying to, do that singular deal on your own.
Got it. Again, I'm reminded of this thing, people try, again, not because social media, the high intensity training, I think it's called HIT. But then obviously it's only for people who doing regularly cardio, weight training, and then you get into that
Absolutely.
HIT mode. I think HIT is what I can think of as a startup investing. Do your basics first
Absolutely.
and get into the
Could
startup.
not have agreed more.
So now with startups and investments and everything behind us, my favorite question, and probably, we were talking about it some time back, equities versus real estate versus gold versus debt. How to differentiate and how to yet have a flavor of everything and to what extent?
I can give you a personal example of how I am investing for myself. Look, I'm an aggressive investor and you have to take it in that stride.
Right.
I have 80% equity and 20% which is tactical.
Okay.
When I say tactical, this 20% may move around gold, may move around fixed income, may move around international, may probably be sectorial investing in equity in itself, right? I don't touch 80% of my equity portfolio ever,
Okay.
right?
Great.
That's my core portfolio that continues to stay. I only play around with the remaining 20%.
Nice.
Right? Of course, this may not be applicable to everybody who's listening to us. So for an aggressive investor, I would actually like to believe 80% equity and 20% spread across fixed income and gold is a very good way to allocate money.
Sure.
Right? A lot of people that I talk to will say, I'm extremely aggressive. Why do I need 20% in fixed income? Right? And I always keep going back to them and telling them that let's say if a 2020 happens or a 2008 happens and you are convinced that market gira hai to upar jayega, but do you have additional monies to invest? Whatever additional money you will have will do nothing in terms of adding to your existing portfolio. It will not even move a needle. Use this 20% then to buy the markets lower. Right? So till the time you don't get this opportunity, it gives you the asset allocation mix that you want. And when the markets are lower and you really want to buy and don't have monies, use this to buy the markets lower.
Interesting.
Right? So 80% equity, 20% fixed income and gold. I am not a very great proponent of doing real estate investing. I am somebody who believes you should have one house to stay.
That's it.
I don't believe that you should stay on rent. While I can show you all mathematical calculations showing you how staying on rent is far more mathematically brilliant than renting out. But I personally believe ek ghar hona chahiye. You should have one house for yourself. But beyond that, I think you have to be a real professional to be able to pick the right real estate for yourself. Right? You look at the last 10 years data, real estate as per RBI's index has generated just 4% CAGR. Right? Let's say outside of this 4% CAGR, you will have 2% rental yield.
Yeah.
Now minus the maintenance, minus the brokerage cost, minus the non-occupant days, you would have not made more than 5-6%, including capital gains and yields. Now over and above that, no flexibility in terms of liquidity, large ticket size. So one, property to stay. Beyond that, real estate. Of course, I'm not saying that people have not done a great job by doing real estate investing.
Yeah.
There are people who will come and tell you that they've done 100x by investing in a land. But ask yourself if you have that understanding and the knowledge to be able to do that. Yeah. If not, I think these traditional investments across fixed income, gold and equity are far more better than trying to crack a jackpot because somebody's made a 100x by investing in land.
Right. So, talking about personal investments, you just mentioned that 80-20 and beyond that, how's your typical day like, if I may ask, and how do you keep yourself on top of things within the world of financial, the broad world of finance and investment planning and wealth? How do you keep yourself up? And what are some of the things that you do so that, listeners can probably take some of those clues as things to follow?
I think in my line of business, there are only two things. I don't know how people are going to take this, but there are only two things that are extremely important. First is, you may not have the knowledge, but you should come across as knowledgeable, for which you will have to do a lot of reading.
Yes.
And that's what I do. I do a lot of reading the entire day because there's actually nothing else to realistically do.
Sure.
I mean, you don't buy and sell stocks or buy and sell things every day, right?
Yeah.
So for us to be able to put puzzles together in terms of what is happening in the global markets, what's happening to fixed income, what's happening to currencies, what's happening to gold, and how is this really going to be able to make any meaningful difference in the investor's life is what we try and figure out by trying to read whatever we can every day.
Yeah.
And second is behavioral management. I think in investing, it is 80% behavior and 20% intelligence, right? So while I talk to clients and I tell them that help you choose the right investment product to invest in depending on what your requirement is. I think that's only 20% of my job. 80% of my job is to make sure that I help you to stay invested in times like these. Because circling back to our discussion, if I'm not going to be able to keep you disciplined, those 12% calculations that you and I are talking about are never going to be realistic in life, right? So I think it is largely about keeping yourself updated with what's happening. If there is anything that is going to meaningfully impact your investors' investment, that's what you want to be able to draw as a conclusion. And 80% of the time is trying to manage behavior in times like these.
Brilliant. So, just as a pastime, or I'm clueless what to watch, I think sometimes I open one of the maybe 5 years, 6 years, 8 years back, clippings of Coffee with Karan show, and within that, the best, one of the best things is quick fire. So let me try and have that session now, just to again put you a little bit of stress.
Do I get something at the end of it?
No, and I'm thinking I'll probably take a signature on a coffee mug and put it on the wall, the Hall of Fame. Yeah, that's probably what we could do. So first is, if you were to choose one person, Kirtan, whom would you like to meet over dinner? That could be living or dead. So, and it could be any from any space.
I think I have always been a very big fan of late Mr. Parag Parikh.
Okay.
Never got an opportunity to interact because by the time
you could get into that zone.
I could step into an audience like that. He was unfortunately not around. But I think I love his philosophy.
Value investing is what
value investing is one. Second, what I love about him, and that's what my WhatsApp status also is, that we don't chase HNIs, we create HNIs.
Wow.
I love that point that he made. And today also, if you go to our website, you will see something that I've borrowed from him.
Okay.
There are only two things why I think people should work with us. One is integrity, and another is understanding.
Okay.
And I think I borrowed this from him. Life is extremely complicated, specifically in our world. You will come across a lot of intellectual people, right? And intellectual people can be right or wrong in the hindsight. But if that's not combined with integrity, I think this business can't run. So I think this is my philosophy in life, basis what I learned from him. And I regret that I never got a chance to meet him.
Whatever little I remember of him in a little bit of media and what I've heard from people, I think modesty was another big trait, and I could see that spark with you as well, and why you were kind of connecting with him. So yeah.
I am humbled. I wish I can even be 1%. Yeah.
It's easy. I would say relatively easy to create wealth and get that laurels and fame, but very difficult to remain modest at the same time. So yeah. Great. So one investment you'd recommend to everyone, and here we're not looking at a stock tip, but
I think mutual funds. I think that's the right way for most investors to actually start investing. And then over a period of time, once you become slightly matured, then there are multiple other options that you can look at.
Great. Worst investment advice you ever got?
FDs are great investments. Was the worst investment advice that I've ever got. And now I understand, being in this business for a long time.
And if you weren't an entrepreneur, what would you be doing?
I would definitely have been a commercial pilot. That's what I actually intended and started, failed miserably, and I was thrown in this business.
Do you have a favorite airlines or?
No, so I don't have a favorite airlines today because unfortunately
it's a duopoly, so Indigo. And
yeah, there is absolutely nothing much. But at some point in time, probably I will want to get a commercial pilot license for myself, because you are allowed to do hobby flying in India.
Yes. Oh wow.
Yeah.
Interesting. It's motivating me also too.
No, so because you don't know my history,
Not
failed.
that I'm motivated to become a commercial pilot, but do something like really.
So I failed aeronautical engineering. So
Okay.
I was post my 12th, I took up aeronautical engineering, and post that I was supposed to do my CPL license.
Okay.
But because I failed aeronautics,
Okay.
I understood that probably I'm not meant to do this, and I moved on. Not that I had to do aeronautical engineering to do commercial pilot license,
Yeah.
but that's the path that I choose for myself. But now that I look in the hindsight, I'm happy that
So the late
life
Mr.
happened.
Ratan Tata also had that, right?
Yes,
And I
yes.
believe if he at his age and the kind of busy man he would have been
That's
industrialist,
been my
if he
inspiration.
could take out time and do
Absolutely.
it, I'm sure.
Absolutely. I think more than inspiration is the cost.
Yeah, it's it's an expensive hobby.
Yeah.
Yeah. How do you take a break? And that's my favorite question. How do you take a break and enjoy the wealth that you creating every day for yourself and for the so personally, how do you cherish your personal and family moments? Anything you could share?
I think I'm a big traveler, if I may say so, and if that's the right analogy to use. I would probably travel every quarter, and I'm on break for 10 days every quarter.
Oh.
Right? And even if that comes at
Hope my HR is listening.
even if that comes at a compromise to acquiring new business or being able to grow the business at the pace at which we would
Okay.
really envisage to, but
It gives you a
I think
break.
that's something that is mandatory and we have to do it.
Hmm.
So I'm a big travel buck.
Interesting. And how about splurging or where all do you splurge? Whatever your definition of splurging is. You said holidays is one, but beyond that, on
I will tell you a phrase that I so relate to, that I don't want to die rich.
Hmm.
I don't understand the reason why people keep saving so much of money
For the next generation.
And for their retirement probably. What are you going to do with crores that you would have when you are 60 but are not able to walk? Right? Makes no sense to me. Of course, I'm not saying don't plan for your retirement.
Yeah.
What I'm trying to say is that in trying to plan for your retirement, don't forget to live life. So I'm a spend thief because I don't want to die rich. The only two things that I largely spend outside of travel is probably a watch and a car.
Oh, okay.
Yeah. So yeah, I have no shame in saying that I spend money because I don't want to die rich.
Understood. So I'm just recalling some industrialists, right? So there's this Vijay Mallya kind of a phase or whatever that zone, and then there is this Narayan Murthy who's obviously modest, not spending too much, and there is this in between. Let's say Mukesh Ambani, इतना पैसा है तो उसको अच्छे से खर्च भी करना आता है उनको, right? He's really splurging, and I think I'm really inspired, right? He's not like, because at the end of the day, whatever he did, it's created so many opportunities and it showed that there is there is a destination within India, let's say a Jamnagar or so much, and see the amount of wealth or the income that would have got generated because of so many functions. So I think there's a merit in every. There's a positive side as well. People are probably,
I think while all of us keep talking about consumption in India, how is consumption going to really fructify if people like you and me don't end up spending, right? One. And I'm actually very moved by Shah Rukh Khan. And I did mention about this earlier, right? And he very well said that, when people come and tell you money is not the motive in life, right? Don't believe in those philosophies before you've actually made that kind of money, right? Yeah. It's easier said than done.
Yeah.
That you don't want to work for monies. I would rather say that you work for monies because once you have those monies, 90% of your problems are already solved, right? बाकी का 10% आपको solve करना पड़ेगा. But I don't really believe in the philosophy that don't make monies or don't spend monies. I'm a spend thief and I love it that way.
Brilliant. So, we all hear about those great success stories, but I'm sure there would have been some oops moment in your journey that would have given you some valuable lessons in investing or entrepreneurship. Yeah. So, any oops moment that you can recall?
A lot of them. Yeah. A lot of them. Actually, we lost a very large sum of investment doing F&O trading.
2008?
No, this was actually 2012, 13 if I'm not wrong with the date. We were standing short on the Bank Nifty, very large leverage position. Raghuram Rajan became the governor, and the Bank Nifty ran some 2,000, 3,000 points in 2 days.
I think it was a taper tantrum
just
before that onset.
2013, if I'm not wrong.
Yes, yeah.
Right, and we lost a big sum because by the time we could react, we didn't even understand what happened.
It's a leverage product.
Right, so since that day, I have made it a point that I will keep spreading awareness about how not to do futures and options without risk management with my personal experience. I would sincerely like to believe that I understand a lot about futures and options. Right? I can talk to you about Greeks. I can talk to you about anything that you would want to talk to me about derivatives at this point in time. But derivatives is way beyond just understanding. It's more behavioral than just understanding. It's more about systems and processes. It's more about risk management. And I don't really think 9 out of 10 people
That's what
really have it in them. I personally don't have it in me. So I keep spreading this awareness. Don't do FNO. There is no overnight success. People have spent decades to become an overnight success in any business, and specifically futures and options.
Great. And if you could go back in time and tell your 25-year-old self one piece of financial advice, what would it be?
I think this is the financial advice.
So one is stay away from leveraged products, discipline,
and second, third is first you decide how much do you want to save, and on the remaining amount you spend.
Understood.
Look, and it may contradict with what I just said that I spend money, right? But please understand my situation is slightly different, right? But if this has to go out as a general advice, I would rather suggest people that you first decide how much do you want to save, and then you decide how much do you want to spend. What people actually do is they spend the entire month, and then at the end of the month, whatever little is available is what they save. That's the worst mistake that you will do.
Sure. So let me just quickly ask you some of those personal. So your favorite Bollywood actor, and not Shah Rukh Khan. Is there anyone? Because Shah Rukh Khan is more of a...
Yeah, so Shah Rukh Khan is more for his philosophy.
He was.
Yeah, but I love Hrithik Roshan.
Oh, and book you would want to advise for on financial planning or investments?
Yeah, I think One Up on Wall Street is something that I really love. Yeah.
Favorite holiday destination?
I think in India, I love Ladakh. I had been there some 6-7 years back. I don't know if I've heard it's become a lot commercial, but Ladakh is my favorite in India. Kashmir is the second. I love both of these places, and South Africa is something that I have loved. Look, I'm a more adventurous person when I do. I'm not a city guy.
Sure.
So yeah, South Africa is where I got everything to do.
Yes,
that I really wanted to do. So I love that place.
That was my first international trip. So yeah, even I have very fond memories of that.
Super.
Yeah. And your current car, I'm poking in current car, and maybe your aspiration or maybe your go-to car next.
Are you going to put this up?
It's up to you. We can cut it.
So I drive an A4 today, Audi A4. And I really want to buy a Maserati.
Wow. Think big, plan well, be disciplined, and God will take you there.
I am hoping so.
Brilliant, Kirtan. I couldn't have asked for a better guest than you in my first podcast. So thank you. A big thank you.
I'm
for
just
being
glad that y'all invited me. It was a great time that we spent.
Yes, we look forward to having maybe one more round. Maybe in the foreseeable future.
Thank you so much for having me.
Thank you. What an amazing conversation we've had today on the House of Equentis. A big thank you to Kirtan Shah for sharing his valuable insights in wealth creation and the importance of sticking to your long-term financial plan. If you found it valuable, please share it with your friends and family, because everyone deserves to understand the power of smart investing. Until next time, keep striving for your financial goals. Stay educated. This is your host, Jaspreet Arora, signing off.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.